Hello YouTube, this is Tu Profe YouTube here, and I'm gonna be talking about a portfolio which is a merge between the cryptocurrency world and the stock world. And I thought it was gonna be very interesting for you to know how I deal with this. So here I am. So don't forget to drop a like and share this video if you like it with somebody that you think could find this useful or helpful in any way in your work or in your study or whatever. And don't forget to, if you want, you can invite me a coffee on my coffee link that I'm gonna leave in the description below. And also, this spreadsheet's gonna be loading in my coffee site uh, for you to download. I'm gonna leave it very cheap, but you can pay whatever you think it's worth. I mean, I'm gonna leave it like for $5, but you can pay anything you want. It'll be just like for helping my channel, and I'll thank you very much for that. And if you can't, well, just go ahead and drop a like and share this video, and you'll help me, and I'm very thankful for it. Okay, let's start. So we have this four cryptocurrency here. We have the quotes that we got from Yahoo Finance. In case you don't know how to download that, well, that's very straightforward. Just go ahead and go to Yahoo Finance and type BTC USD or BTC only, and just go to the historical data and so on, and do that for the rest of the currencies. So I have those for 5 years with a frequency of 1 month in between. And I also have four stocks that I think it's gonna be very useful for us. So the first one is EL, which is Eastern Lauder or Laudo. I don't remember how it says, how you say it. Well, that's cosmetics. Yeah, cosmetics. And I think and I've been watching that stock, and it was a pretty good stock to me. I was analyzing this the other day, and it was pretty cool. It was pretty attractive investment to me. Okay, this is okay. For the next one, we have General Electric, PayPal as a fintech, because I don't like banks, and the other one is Taiwan Semiconductor Manufacturer, or yeah, TSM. And well, let's find this efficient portfolio. Okay, so let's start. So like we did before, we're gonna be finding the returns here. So first, the natural log of the future over the last. Yeah, and you just go ahead and copy, paste, copy, and paste to the very end. Here, Control V, let's go down here, get the average. We'll get the average. Yeah, copy and paste. Okay, this is nothing. This is actually nothing. Okay, what I did was just find the returns of the stock. So I took the natural log of the future value over the last value, over the past value, and that's basically it. Now I'm gonna have to subtract each of the values minus the each of the averages, and for that I'm gonna be hitting twice the F4 key, so I lock the rows. So I drag to the right and drag down at the very end. And then I click over here and see that everything's all right and everything is subtracting the way it should. Okay, we're all good here. Now to get the variance covariance matrix, we select the spaces and we hit M mode, transpose. I'm gonna be transposing the recent calculation that we did, close parenthesis, comma, and then we select the same matrix. Alright, now we close the parenthesis, divided by, open parenthesis, count, and I'm gonna be counting the number of rows that we have here, then -1, shift, control, enter, and there we have it. That's the variance covariance matrix for the cryptos. Now let's do that real quick for the stocks. Okay. Right, so maybe you're thinking, why do I have two matrices over here? Well, this one is the correlation matrix that I took the liberty to do. Let me just go ahead and do it real quick for you so you can check, because I was kind of like wondering if those were a good choose, if I choose the right stocks or anything. But yeah, you'll see in a moment. Okay, so let's remember equals and mode open parenthesis transpose the recent calculation, close parenthesis, comma. Now we select the same matrix again, close, divided by, open parenthesis, count. Yeah, the values, -1, close, shift, control, enter. Okay, so finally, let me just go ahead and get the variance real quick, and I'll show you what I mean. I got the sample, so I get the variance for this. Yeah, and those variances, I think that's the pro of it. Should coincide with the with the interception. I mean, from PayPal, it's gonna be 0.01403, and this is the value, and so on. Look, all right. Okay, great. So now the correlation matrix. That's gonna be the variance covariance matrix divided by a mode, and I'm gonna be transpose, and I'm gonna be oh, forgot something. I was gonna be finding I need to find the standard deviation of it. Okay, now we're ready now. Okay, so equals the variance covariance matrix divided by a mode transpose. I'm going to be transposing the standard deviation vector and multiply it by itself. I think this is it. Okay, shift control enter, and that's it. Okay, so yeah, they're not so correlated, so I think this is pretty much diversified. I'd like to see some negative numbers over here, but well, that's fine. That's totally fine. I mean, that's perfectly fine. Okay, it looks good. Okay, now the crypto plus stocks. So I just I'm gonna be back here in a moment, but I'm gonna be linking the returns for just what we have. And then from Easter Lauder, I'll go to these stock values and I'll just pick the returns, and I'm gonna link it here and to the very end. Yeah. Okay, now now the expected return of the portfolio of crypto under return. This is the thing that I didn't show you before. Okay, now I'm gonna be doing the same stuff that I did before, linking the values from one sheet to another, so it'll look a lot better. I'm just linking, the values. That's practically nothing what I'm doing here. I'm just selecting the values and putting in so I can make my calculations a lot better. All right, so here we're gonna be okay. So 1, 2, 3, 4, 5. We have 5 stocks. So 1 divided by 5. I'm gonna start off with okay, 20%. I'm just doing 20%. I'm gonna be using an even distribution for both uh, portfolios. I mean, I'm gonna be dealing with 2 portfolios. One of them is gonna be crypto, and the other one's gonna be the stock portfolio. And I'm gonna mix them both. You know, the optimized portfolio of both to get another one. That's basically what I'm gonna do. So this one, it's gonna be 25% here, because it's gonna change in a moment. Okay, and the expected return of the of this, we already got that. So we go over here and select it. Yeah, exactly. So I do the same for the stocks. Yeah, for the expected return, or the annual return for the stocks, the average return, that's what I did. And now for the variance, we already have those for the crypto, I think. Well, we can find that. Let's just go ahead and find that again. Variance.s. And let's do the crypto for here. Okay, for the returns. All right. Then we drag it to the right, and standard deviation, that's going to be this, just the square root of it. You got, and the risk-free rate, and I believe that's going to be 0.47%. That's what I had a APR in Binance this morning. That means since we have this monthly distribution, we have to turn this into a monthly rate. So monthly, that would be this divided by 12. All right, let's do the same for the stocks. So var.s for the variance for the stocks, the stock returns. There you go. You have it here, right? Yeah, and the standard deviation to the 0.5, and the risk-free rate that I believe this, it's gonna be 5 or 5.5. You know, the T bills for 10 years T bills. So that's effective. That's effective annual. So let's turn this into effective monthly rate. That to the 112 minus 1. There you go. Here we have it. Okay, great. All right. Now, the portfolio return, that's going to be some product of the weight and the expected return. There you go. Wait, that was supposed to be here. Yeah, great. Okay, now for the variance, you go like this. And mult. Now, since this is already horizontal, and mult. Now the variance covariance matrix, comma, transpose the weights. Let's close this up, and I believe this is okay. Shift Control Enter. There you go. Now the square root of this, and the Sharpe rate, you will. That's the expected return of portfolio minus the risk-free rate over the standard deviation. Let's do the same for the other portfolio that we have up here. Okay, so the expected return, that's some product, the expected return times the weight vector, this amount, the weight, comma, and multiplication, matrix multiplication of the of the matrix, comma, transpose the weight. Let's close this up. Shift Control Enter, and the standard deviation, that's to the 0.5. All right, and now the Sharpe ratio, that would be the expected return of the portfolio minus the free risk rate, the risk-free rate. All right, and we have that. Okay, great. Now this one, as you can see here, let me turn this up. Wait. Okay, this one that you see over here, something's wrong with this mouse. Okay, this one provides a higher return, so I'm gonna optimize this to the Sharpe ratio. And this one, it's a lot more stable, because if you can see here, the standard deviation of the portfolio of the crypto, it's a lot higher than the standard deviation of the portfolio that uses stocks. So let's just go ahead and find the optimum value for both, for the best of both worlds. So let's reset all. Yeah. All right. So okay, let's get this cell to the max by changing the values over here. Right. And let's add a constraint. The constraint that's gonna be that this value should be 100%. 100%. Okay. Okay, let's fire. Let's see what we get. Okay. So this is what provides the best results. Optimized the Sharpe ratio. Let's do the same here, but we're gonna be doing here. What we're gonna be doing here is gonna be optimizing to the minimum variance. So we're gonna be finding out the minimum variance portfolio. So this value over here to be the minimum possible by changing this vector, and this time we're gonna be okay, let's change that this value should be 100. Okay, I think everything is in order from K to N. Yeah, and this. Okay, go ahead and solve. Let's see what we got. All right, so this is the portfolio that gets us the best, the minimum variance portfolio for these three stocks. Okay, so let's just go ahead and go back to here, and I'm gonna be linking the weights for each of the portfolios to this page, to this tab. Yeah. Okay, now what we're gonna be doing here, we're gonna be finding out the return, the expected return for each of the portfolios. This is the portfolio of cryptos, and this is the portfolio of stocks. So sum product, and I'm gonna be selecting this vector, but only until Ripple, no XRP, and I'm gonna be yeah, I'm gonna be locking the cells, the rows, comma, and I'm gonna select those the first values here, right? And now for this one, it should be like just punching F4, and that's it. I'm gonna do that for here. It has no use for me to be just clicking this twice, so let's just hit it once. Or yeah. All right, let's select this let's select both cells and drag it to the very end. Here we go. Now here, covariance sample. And the first array is this, comma, the second array, which is going to be this one. So we got the covariance for both portfolios. All right. So let's fill this up then. Okay. So first we're gonna be linking the covariance from this file, and I'm gonna be assuming some percentages. Let's assume 20%. So that means that the portfolio of stocks, that's gonna be the rest, right? Wait. Wait. 100 minus the one above, 80%. Okay. All right. Now, for the variance, let's just get, okay, so first of all, let's get the expected return. So the weight of crypto times the expected return of crypto plus the weight of the stock portfolio times the expected return of the portfolio. That's it. Okay, great. Now for the variance, okay, so for this one, we're gonna be using the standard deviation or the variance. Oh, the variance over here and the weights. So first, we're gonna be dealing with the crypto. So weight of the crypto square times the variance plus weight of the stocks square times variance of the stocks plus 2 times the weight of the crypto, the weight of the stocks times the covariance. And this is how we got the variance of the best mixed of the portfolio. And this is just the 0.5 here. And now I'm gonna be finding some kind of something close to the risk-free rate. This is not gonna be like a very orthodox calculation, but well, I guess it'll do. I'm just gonna multiply the weights times its risk-free, so I get something in the middle. The Sharpe ratio, of course, that's gonna be the expected return of the portfolio minus the risk-free rate over the standard deviation of the portfolio. There we have it. Okay, great. Let's get the values of the let's reset all. Yeah, let's reset it all. Let's get this value to get this optimized to the Sharpe ratio. Finally, to the Sharpe ratio. You know, the mix is going to be optimized to the Sharpe ratio. So by changing the variables, the only thing that we're going to be changing is the weight of the crypto to get the maximum value. Okay, and that's it. We don't need no constraints here. So let's just go ahead and solve, and there we have it. So the expected return of a portfolio is 93%. Do this. Just in case, yeah, at 93% of the weight of crypto. What happens if I punch 30? What happens if I punch 40? 93. Okay. Okay, well, good. Yeah, okay. Good. I suppose let's run it again. Yeah. I was wondering if well, yeah. Okay, we'll find out very soon in the graph. Okay, here, let's see. Okay, so this is gonna be the expected return. Copy. We paste it, and the standard deviation. Copy and paste it. This is gonna be the values for the maximum Sharpe ratio. All right then. Yeah, well, we have a slightly lower standard deviation that we had before. Than we had for the portfolio of cryptos, and we have slightly lower and much higher return. Okay, let's keep going. So I'm gonna be linking this standard deviation and the expected return of the mixed portfolio, and let's start off from -2 plus 0.1. Let's drag this to until we get to oh, there you go. All right, let's select this and let's go to data, what if analysis, data table, the input row, or the column, excuse me, it's going to be the green cell. Okay, let's select this, just this, and insert the graph. This works. All right, let's put this a little higher here so we can see. Okay, so this is the efficient frontier, and let's see where we get this value for the max ratio, the max Sharpe ratio. Let's add this up. Add, and this is going to be max Sharpe, and the x value, it's going to be the standard deviation, and y, the return. Okay, so you can change this as much as you want. Okay, let's see if I can do something a little better here, a better job here. Format of the label and the series name. You can change this the way you want it. I mean, this is the name of this. Should be Efficient Frontier Best Mix. Max titles from horizontal. Well, we can just standard deviation. Now let's add vertical. And this is going to be expected return. Well, this is basically it. So so that's it for today, guys. So don't forget to drop a like and share this video with someone that you think it's gonna find it useful or worth it. Don't forget to I'm gonna leave this file on my Ko-fi site, and if you want to invite me a coffee, well, thank you very much for your kindness, and I'll see you later. I'll see you in another time. So take care. Bye bye. Thanks a bunch.
I have to go and boom boom. Let's go. Put guns. Gata mata hoetero motherfucker. Ai teni dekinai. Yume kara samenai, yume samenai. Itsu kara kono seikaku arumae. Naraba, kureba, 自分がなけりゃ流される津波。ミキサーお前のせいで。レベラフォロワーやっぱりお前のおかげで。右見て、左見て、右見て。ほら全てが幻。舐めたきゃ舐めとけ。代わりにゲロ吐く。I have to go and boom boom. Let's go. どこへ Put guns. どこへガタまた吠えてる motherfucker. 相手にできない。迷える子羊たくさん目に間にそれでも懲りずに貫くべき金本だ。